Hello and welcome to our September 2025 Market Outlook and Positioning video. My name is Derek Varner. I'm joined by my friend and colleague Mike Allison. Hello, Mike. How are you?
I'm great, Derek. How are you?
Good. So we're going to dive into what's been going on in the markets and the economy this summer. But so far, good news to report. Markets are up significantly year to date, depending on how you measure it. So we have on screen now the S&P 500 up about 11%, dividend stocks, small cap stocks up kind of mid-single digits, and then foreign markets, as we reported on last time, up close to 20% or beyond as an index. So, Mike, I wanted to first touch on get your opinion on why do you think this is? Why have we experienced such a positive year in the market, especially after two very good years prior to 2025? And in particular, I think August was a very good month for markets as well. So I would love to get your take, and then I have some thoughts as well.
Yeah, I think it's a combination coming. Yes, we were coming off of two strong years, but I think that this year's been driven partly by, frankly, continued strong earnings, and some folks having an expectation of an economic slowdown. And yes, there are soft spots in the economy, but no sign of recession at this point. Matter of fact, I believe I just saw an upward revision of second quarter GDP. But just enough softness in the labor markets to give the Fed some headroom to lower at least short-term interest rates, which um, you know remains to be seen how that would impact mortgage rates and that sort of thing. I doubt a lot, but it could shake loose some of the significant amount of cash that's still parked on the sidelines, earning pretty good returns in money market funds. So that's some freed up, potentially freed up dry powder that could come into the market. And so some expectation of that has also, I think, been part of the driver of strength.
Yeah, that's well said. So I think you said we're in a Goldilocks environment for the time being, or is that a bridge too far? Maybe not quite there, but
No, that what I wouldn't say we are in. I have always said that that would be my Goldilocks scenario where you have a broadening out of the equity market position, not so concentrated at the mega cap end of things. And I think we've started to see some of that this year. And frankly, one of the drivers of non-US performance partly was valuation, much more attractively valued equities, but also a weaker dollar, which has driven some of that rotation as well.
well, what's been encouraging this year, or I should say in the month of August, was the very significant outperformance of small cap stocks. So there's a whole host of potential implications from that. But when we look at this, when we go down the list here of the different asset classes, which we touched on a moment ago, large cap stocks up kind of 9 to 11%, dividend stocks up 8, small cap stocks you see up about 7. But what's important here is that all of this return happened in the month of August. So small cap stocks were up 7.2% in August. And that was really, I think, driven by partially what you were describing, Mike, the expectation for continued economic growth, but also the potential for the US Federal Reserve to lower interest rates. So a much more, we'll say, uh, compassionate environment for smaller companies, which tend to be more economically sensitive.
I agree. Part of it's structural too, in the sense that if you we have such a highly concentrated market cap weighted S&P 500, the top end is so heavily weighted, such a significant amount of the market cap of the S&P 500. Any whiff of a better operating environment for small cap, you could see money coming out of those mega cap stocks, not even that much of it, and still as long as it stays invested, and if it gets allocated to smaller cap names, the relative size of the market caps are so significant that you could still be at a very early stage of a small cap rotation.
Well, I hope you're right because it's an area that we have exposure to in our portfolios and we see value in. So why don't we go to valuations next, just because you touched on that subject. So you mentioned the concentration in large cap stocks. We've touched on this last month, so I don't think this is something we have to go into in extensive detail, but just as a reminder, of the S&P 500, We have a pretty significant amount of the that index is owned or controlled by just 10 companies, but a lot of the earnings from the S&P 500 are also being driven by those 10 companies. So I think what investors have been looking for are signs that other parts of the market outside of some of the biggest mega cap tech names can also find ways to grow and expand their earnings in the future. But when we look at valuations across different asset classes, we touch on this each month. We do see the S&P 500 and large growth stocks trading at basically their highest price to sales ratio that they've experienced in the last 15 years, but just the equally weighted S&P. So giving every company in the S&P 500 an equally weighted component as opposed to a market weighted component leads to a much more reasonable valuation, or at least on a price to sales basis. And then we look across a lot of other asset classes like, as we said, dividend stocks, mid, small. Foreign and emerging stocks are kind of at the higher end of their range because they have experienced a nice uplift this year because of, as you said, the US dollar declining, attractive relative valuations. But we think, this is after 15 years of fairly depressed foreign stock valuation. So we're not overly concerned about foreign stocks trading at the highest end of the range at this point. Mike, what are your thoughts?
I agree. One thing that I would point out when we think about price to sales and the large growth stocks, that looks kind of wow, it'd be unjustified that on a price to sales basis that is the case. But you also have to reflect the profitability of those companies and what operating margins are, and because it's such a capital light industry, that some of that price to sales is a function of profitability as well. So you have to look at multiple metrics, and because not all companies are as profitable as others, and so you need to reflect that, and that's partly the justification for some of that price to sales disparity. Although, it's that's only a partial explanation. And definitely, valuation expansion has been significant over the last few years, and the relative valuation disparities, not only price to sales but also price to earnings, are significant. And I think that's once the market starts to have more confidence in the earnings power of other names outside the top mega cap names, then we're going to could continue to see a broadening out.
Well, all said. So let's pivot back to the U.S. Federal Reserve, and then I want to hit on earnings as well. So the Fed, I think we've touched on where the Fed is pretty extensively in the last few videos, but we got some confirmation in the month of August that the Fed intends to continue along their path of lowering interest rates. They were on an extended pause for much of 2025, I think primarily as they digested tariff announcements and what that would potentially mean for inflation and economic growth. So far, we have not seen a significant pickup in inflation, and as we said, the economy continues to move forward. Corporate earnings continue to move to move higher. We have seen a little bit of a softening in the labor market, and I think that's given the Fed enough room to say we're ready to continue along this path. So right now, the Fed is anticipating moving interest rates lower along this kind of blue line here, the chart courtesy of J.P. Morgan. But the market has started to price in a little bit more aggressive interest rate cut. I think we would probably be in the camp somewhere in between here. But Mike, your thoughts?
Yeah, I think one of the things to keep in perspective is, we're not talking about a single rate. We're talking about Fed funds rate, which is at the short end. And you could argue that if inflation is going to be in the call it the 2.5% range, and my view is that 2% inflation target was never realistic. 3 is too much, but historically, inflation has been in the 2.5% range. And so let's assume for the moment that that's where inflation settles in. So now you have a Fed funds rate that's a positive 200 basis point or so real return, which historically is too high for cash, or short term. So you could argue that they could lower short-term interest rates, and the longer part of the curve, 10 years and out, doesn't really move. And so then you have a sort of a normally sloping yield curve in that context. It feels what's not normal is to have short-term rates so high relative to inflation. And so I think that softness in the labor market is going to give some cover for the Fed to work their way back towards a normal Fed funds rate.
And as you said at the beginning, hopefully that also will encourage a lot of the cash on the sidelines to move into risk assets like stocks and bonds. And we view this as all the money that's been sitting in money markets, short-term treasury instruments, CDs, you name it. We hope that this money will eventually kind of find a new home in some of the securities that we own in client portfolios. So on the earnings side, we saw a pretty good second quarter earnings season. In terms of sales growth, we saw about 6.2% sales growth year over year for the S&P 500. Most companies have reported as of last Friday in late August. And earnings growth was about 12% higher year over year for the S&P 500. And you can see that was in some of the usual suspects like technology. Communications now includes Google and Meta, which are two large AI companies. But importantly, the earnings surprise. So earnings surprised Wall Street analyst expectations by about 8%, which means that what was being priced into the market or what was expected going into earnings season as of the end of the quarter was exceeded. And I think that helped move markets higher. But any key takeaways from you, Mike, from earnings season or any anecdotes that you think we should talk about?
I think one of the surprises, to some at least, is the strength in the earnings out of the financial sector, where and you've got um, you know animal spirits in some of the lending. You've got likelihood of lower short-term rates, which means demand deposits get cheaper, and so the spread that they can lend out, the banks can lend, it broadens out, and so they're showing solid earnings growth, but also coming out of you kind of look historically about how sick the sector was coming out of the great financial crisis, and then after that, all the restrictions placed on them, and to the extent that you have a less regulatory posture from Congress and the administration these days, as compared to say 10 years ago, I think that there's some chance that you're unleashing some significant growth, especially from a cyclical perspective, if we don't go into recession.
Well said. I like your optimism there. So let's end on our dials as we call them, as we usually do end here. So from an economic perspective, I think the growth rate of the U.S. economy is seems to be trending a little higher. It's kind of running at or slightly above the kind of long-term average real GDP of about 2 to 3%. And, investors have viewed that very favorably this year because of concerns around the potential for a US recession in 2025. But just because we're still kind of at the long-term average growth rate, we've listed this as a neutral component. Employment, we still list as positive despite seeing some softening in the labor market. And then households, we list as neutral because despite continued household spending, we are seeing some signs of some stress there, as well as lower household sentiment. On the financial condition side, this is where we track things like monetary policy, interest rates, and inflation. And I would say my hope is that when we speak to you again in a month or so, that we should move this to a more positive direction, that we'll see more confirmation that interest rates are coming down and that inflation has been largely stabilized. And then lastly, we do list valuations as neutral because of that big bifurcation between large cap technology stocks, primarily technology and communication stocks, and the rest of the market. But because those companies play such a significant role in investors' portfolios and the market in general, we list that as neutral. Earnings, as we just saw, trending in the right direction, looking very positive. And then trend itself, is the market going up or down? We did move that to positive this month because we think we're seeing, some renewed confirmation of a sustainable bull market. So generally, we're somewhat mixed here in our view. We have a kind of a neutral, cautious stance, and a lot of our client portfolios are positioned that way, that we have balanced exposure across things like equities, fixed income, cash hedging strategies, and even some inflation hedging investments like commodities. Mike, what are your thoughts as we close this month's video?
No, I think it's there are countervailing forces which kind of pull us to be cautiously optimistic, I would say, and positioned that way. The one thing, that we all believe, investors do, is that earnings expectations drive markets. And as we sit here in September of 2025, the market is now starting to think about what does earnings growth in 2026 look like for the market, and who's going to accelerate and who's not. And I think the expectation of that is what's going to drive whichever parts of the market outperform. And so I think the big thing to focus on, as is always the case, but particularly now, given the sort of mixed signals we have in the economy, and the market, is earnings expectations globally, not just U.S., but the U.S. across the cap structure spectrum, but also non-U.S., in particular developed Europe.
There's never a shortage of news and things to track. So well said, Mike. Thank you very much for your great insight as always. And we thank everybody for watching this video. We look forward to speaking with you again next month. And please reach out to your financial advisor or anyone on the team to discuss your portfolio in greater detail. Thank you very much and have a great rest of the summer.
Thanks, everyone. Thanks, Derek.